let's start with something honest. Most people do not think about their credit score until they need it, until they apply for a car loan, a mortgage, a credit card, or an apartment. And suddenly that 3-digit number decides everything. The interest rate, the approval, the deposit, sometimes even the opportunity. And the most common question people ask is this: how can I raise my credit score fast? Not eventually, not someday, but fast. Today, we are going to answer that question clearly. No gimmicks, no illegal tricks, no credit repair myths, just practical, proven steps that work within the US FICO scoring system. Because once you understand how the system actually calculates your score, you can improve it strategically. And yes, sometimes faster than you think. My name is Donald, and I help people understand how small financial decisions create massive long-term results. And your credit score is one of the clearest examples of that principle in action. Small decisions, repeated consistently, can move your score dramatically over time. Let's break this down step by step. First, what does fast actually mean? Before we begin, we need to define something. When people say raise your credit score fast, they often imagine 50 points in a week or 100 points in 10 days. That is not how credit works. Your FICO score updates as lenders report information, usually monthly. So realistic fast improvement means 30 to 90 days, and sometimes even 30 days can make a noticeable difference if you focus on the right factors. Remember, FICO scores are based on 5 categories. Payment history makes up 35%. Credit utilization makes up 30%. Length of credit history makes up 15%. Credit mix makes up 10%. New credit makes up 10%. If we want speed, we focus on the categories that move the needle the most. That means payment history and credit utilization. Let's begin with the biggest impact step. Step 1, lower your credit utilization immediately. If you want the fastest possible improvement, this is usually the lever to pull first. Credit utilization makes up 30% of your FICO score, and it updates quickly. Utilization measures how much of your available credit you are using. Here is a simple example. You have one credit card, the limit is $5,000. The balance is $4,000. That is 80% utilization. To the scoring system, that signals risk, even if you are making payments on time. Now imagine you pay that balance down to $1,000. Now your utilization is 20%. That change alone can increase your score significantly, sometimes within a single billing cycle. The general guidelines are simple. Below 30% is acceptable. Below 10% is optimal. If possible, aim for single-digit utilization. And here is something important. Utilization is calculated per card and overall. So if you have 3 cards and one of them is maxed out, it can still hurt your score even if your total utilization looks fine. The fastest way to improve is to pay down high balances aggressively. Even partial payments help. If you cannot pay everything off, focus on bringing each card below 30% first. That is the threshold where the scoring system begins to reward you. This step alone can produce noticeable improvements in 30 to 45 days. Step 2, never miss a payment again. This may sound obvious, but it is critical. Payment history makes up 35% of your score. It is the largest category. If you have missed payments in the past, you cannot erase them overnight, but you can stop making it worse. From this moment forward, no missed payments. Set up automatic payments for at least the minimum amount due. Even one 30-day late payment can drop a strong score significantly, but consistent on-time payments begin rebuilding trust immediately. FICO scores place greater weight on recent activity. That means positive behavior now matters. If you have struggled before, this is where you regain control. Consistency builds credibility. Step 3, ask for credit limit increases. This is a strategic move many people overlook. If you increase your credit limit without increasing your spending, your utilization automatically drops. For example, you owe $2,000 and your limit is $4,000. That is 50% utilization. If your bank raises your limit to $8,000 and your balance stays the same, your utilization drops to 25%. You improved your ratio without paying a dollar. Many credit card companies allow you to request a credit limit increase online. Before you request it, ask whether it requires a hard inquiry. Some issuers use a soft inquiry, which does not affect your score. If it requires a hard inquiry, weigh the trade-off carefully. Usually one small inquiry is minor compared to the benefit of lowering utilization. Step 4. Become an authorized user strategically. This step can help in certain situations. If someone you trust has a long credit history, low utilization, and perfect payment history, they can add you as an authorized user on their card. When reported to the credit bureaus, that account may appear on your credit report. This can improve your average account age and strengthen your overall profile. Keep in mind that newer FICO scoring models reduce the weight given to authorized user accounts compared to accounts you own directly. So this strategy works best as a supplement, not a substitute, for building your own credit. Also remember that if the primary account holder misses payments or carries high balances, it can hurt you as well. So this must be done carefully and ethically. Step 5. Check your credit reports for errors. This step does not require money. It requires attention. You are entitled to free credit reports at annualcreditreport.com. Review reports from Experian, Equifax, and TransUnion. Look for incorrect late payments, accounts that are not yours, wrong balances, duplicate entries, or old debts that should have aged off. Errors happen more often than people realize. If you find an error, dispute it directly with the credit bureau. If an incorrect negative mark is removed, your score can increase quickly. This is one of the few ways to see rapid improvement without changing behavior, because you are correcting inaccurate data. Step 6. Pay down collection accounts strategically. If you have accounts in collections, they are already damaging your score. Here is what you need to know. FICO 8, which is still widely used, does not ignore paid collections. They remain on your report. However, FICO 9 and newer models ignore paid collections entirely. More lenders are gradually upgrading to these newer models, so the impact of paying a collection depends on which model your lender uses. Either way, resolving collections is still important for your overall financial profile and required by some lenders before approving certain loans. If you negotiate payment, you can ask for a pay-for-delete agreement. Not all collection agencies agree, but some do. If they remove the account entirely after payment, your score may improve regardless of which model is being used. Always get agreements in writing before paying. Step 7. Avoid opening too many new accounts. When trying to raise your score quickly, stability matters. Each new credit application triggers a hard inquiry. Multiple inquiries can signal risk. Opening new accounts also reduces your average credit age. If your goal is improvement in the next few months, avoid unnecessary applications. Let your existing accounts stabilize. Step 8. Keep old accounts open. Length of credit history makes up 15% of your score. Closing old accounts can shorten your average age. If a card has no annual fee, consider keeping it open even if you rarely use it. Make a small purchase every few months and pay it off immediately to keep it active. Time is an asset in credit scoring. Do not reduce it unnecessarily. Step 9. Reduce overall debt strategically. While utilization focuses on revolving credit, like credit cards, installment loans also matter. If you are close to paying off an auto loan or personal loan, completing it successfully strengthens your profile. But do not rush to pay off loans if it strains your emergency savings. Stability matters more than speed. How much can your score increase? That depends on your starting point. If your score is low because of high utilization, lowering balances can sometimes increase your score by 20 to 80 points in a few months. If your score is low due to missed payments, improvement will be slower. because payment history takes time to rebuild. If your score is low due to errors, fixing those errors can produce quicker results. The key is identifying your primary weakness. Not all credit problems are the same. Let's be clear about what does not work. Carrying a small balance to show activity is unnecessary. Paying interest does not boost your score. Closing credit cards to simplify things can lower your score. Applying for multiple cards at once rarely helps. And credit repair companies cannot legally remove accurate negative information. Only time and consistent behavior can fix accurate data. Raising your credit score fast is possible, but maintaining it is more important, because this number influences your mortgage rate, your car loan rate, your insurance premiums in many states, your approval odds, and your financial flexibility. Small actions matter. Paying on time, keeping balances low, monitoring your report, those habits compound, and over time, they create massive financial advantages, not because the system is emotional, but because it is mathematical. Predictable systems can be mastered. If this changed how you see money, then you are exactly who this channel is for. Here, we break down financial truths most people were never taught, and we do it in the simplest way possible. If you found this helpful, consider subscribing, and I will see you on the next one.